Let's get you to the weekend. I wish it was Friday. From New York City this Monday morning. Good morning, good morning. Let's get your week started. Equity futures on the S&P 500 totally unchanged. We've got a banking deal we need to talk about. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, JP Morgan acquiring failed regional bank First Republic, leaving the door wide open for the Federal Reserve to hike once again as the GOP challenges the Senate to pass their own debt limit bill. We begin with the big issue. We have a deal. JP Morgan's Jamie Dimon winning the bidding to acquire First Republic Bank following an emergency government-led intervention. The bank will take over First Republic's assets, including about $173 billion of loans, $30 billion of securities, as well as $92 billion in deposits. This is the fourth time an American bank has failed in less than 2 months. And once again, investors are asking themselves, is there more to come?
The bank that was caught by the friendly fire.
What's fascinating is that banks can fail while their loan books are performing.
We have a lot of questions that are hanging out there.
There clearly is something systemic here.
There are certainly more troubled banks out there.
The question is whether or not it's only within banks that interest rate risk has been mismanaged.
We know there will be a lot more bank regulation following.
This doesn't really seem like it's a cliff. It seems like it's something that's going to come in, in terms of dribs and drabs.
What we're left with is the Federal Reserve with a tight monetary policy in place.
Today, a lot of the assets on banks' balance sheets are yielding 3.5%, and they're funding them at 5.5%. That is a losing proposition.
We're seeing a tighter lending environment coming up.
This financial stability issue, of course, has changed things.
Ongoing stresses in the banking sector are something we need to worry about.
Joining us now to discuss Bloomberg's Sonali Basak. Sonali, we have a deal.
We do have a deal, John. It was somehow weeks in the making, somehow days in the making. And we're looking at First Republic now. There are things that are sweeteners that JP Morgan does get in this deal, although it is certainly a deal that they are buying for a song still. Now, remember, FDIC is providing $50 billion worth of fixed rate 5-year financing, and JP Morgan is not assuming First Republic's corporate debt or preferred stock. Now, that is the deal for JP Morgan, along with the details that you had said about the loan book and the deposit base being acquired. But then remember, also, there's this broader issue, this burning question for the system at large. JP Morgan said the systemic risk exemption was not required. Now, was it needed, and would the government have stepped up if it needed to get to that point? That is now an open question for the market. And what does this mean for the broader banking system? We know that First Republic in its kind of final days faced some significant flight when it came to its deposit base in its own right. Now, do we face more issues in the banking system is, again, an open question. JP Morgan can't do this multiple times, though they did come out on top in this bidding war.
Sonali, wonderful to hear from you, and looking forward to your coverage through the week at Milken in California, at the epicenter of the banking issues of the last couple of months. Sonali will be with us again, I believe, in about 27 minutes' time. JP Morgan, the market casting its vote. That stock is up by more than 4% in the pre-market. The South Side with a lot to offer this morning on the deal. UBS's Erica Najarian weighing in on this, saying we think this elegant solution should lay to rest outstanding investor concerns on liquidity, especially given results from mid-cap banks that reflect challenging cyclical trends, but not acute liquidity issues. I'm pleased to say that Erica joins us right now. Erica, wonderful to catch up with you. I assume you were on the call about 15 minutes ago as well, so thanks for being with us. This came from Wolfe Research. They asked on this call, the analysts wanted to understand why the bank isn't expecting greater earnings accretion given JP Morgan's less expensive funding base. Jeremy Barnum, the CFO, turned around and said they're trying to be a bit conservative. He says the situation is an uncertain one. My question to you, Erica, is JP Morgan downplaying how good this deal is for them this morning?
Yes, I do think so. Remember, JP Morgan is known for giving conservative outlooks on earnings, whether it's on their own or for this deal. That being said, later in the call, Jamie did say that they're not in the business of, significantly growing jumbo loan mortgages to private clients, which is the bread and butter of First Republic. So we have to consider that in the math.
Can you talk to me about the kind of assets that they're acquiring? They also said on that call that First Republic was known for very good credit discipline. Are those jumbo mortgages very good credit discipline?
Yes, so First Republic is actually quite pristine on the left-hand side of the balance sheet. All of their problems came from the right-hand side of the balance sheet. If you look historically from when the bank was founded in 1985, it significantly outperformed industry peers on credit quality, right? Their client selection is ultimately, what they have been known for. The marks that JP Morgan is taking is a difference between where you can originate a mortgage loan today and where they're on the books for, not necessarily for credit.
Erica, any idea of what this combined entity is going to look like now? What happens to First Republic branches? What happens to the brandings? What this is all going to look like over the next few months and quarters?
It is likely that we have seen the last of the First Republic brand. So whenever someone like JP Morgan acquires another entity, clearly that's going to be folded into JP Morgan. Now, it's very possible that some of the branches in New York and San Francisco and Jackson and Palm Beach will be turned into Chase private client centers. So I think that's going to happen. But let's be very, very clear here. JP Morgan is going to fully integrate First Republic into its bank, branding included.
Going forward from here, there's going to be a lot of questions about who's next, what's next, is this the end? On the banking failures, Diamond, as you know, said this is getting near the end of it. Erica, do you share that view?
I do, and this is why I call this solution elegant. So I think this puts to rest, the whole discussion on who's next, because if you think about the elegant solution where the provided, the provided solution is the best cost solution for the FDIC and the government, right? And then you pair that with pretty good mid-cap bank earnings as it relates to deposit flow versus the fears in the market. I think this should lay to rest the acute liquidity worries that the market has for the banking system. Now, that doesn't mean that there aren't challenges from higher interest rates, from a coming recession, and from coming regulation. All of those will pressure returns. But in terms of acute liquidity issues, that should be mostly behind the sector.
Erica, just finally from me, because I know you're super busy this morning following that call, and I'm sure you've got to talk to clients as well. Did you get all the answers to the questions that you have this morning, or is there anything outstanding?
So look, I mean, this deal, this marriage is a shotgun marriage, right? It happened over the weekend. It was announced at 3:45 in the morning. Like many investors, there's still a lot of questions outstanding, such as the structure of the loss share agreement, in addition to the earnings accretion. But I suspect we'll know more on the May 22nd Investor Day that JP Morgan is putting on.
I think we're all looking forward to that now. Erica, thank you for being with us and carving out some time in your schedule this morning. Erica Najarian there of UBS. On the latest on this call and this combination between JP Morgan and First Republic. Weighing in on some of this, Morgan Stanley's Michael Kushner, Mike Contopoulos of RB Advisors. Now, to the two of you, I won't ask you specifically about the nature of this deal. I will ask you this, though. Mike Contopoulos, a lot of people will be watching this thinking right now, are we really coming off the back of another bank failure and the Federal Reserve is about to hike interest rates again? Does that make sense to you?
It does make sense to me, Jonathan. I think we've talked about this before. The number one issue for the Fed is not growth, it's not credit conditions, it's not bank failures, it's not earnings, it's inflation. And so I think it makes total sense that the Fed's about to hike. And listen, I think investors need to wake up to the idea that they may not stop with one more. And they're going to be sorely disappointed when they realize above everything else that's going on in the world today, inflation, that's what matters.
And Michael Kushner, do you agree?
I think that is true. Inflation is the bête noire of the economy, and we have high interest rates and rising interest rates because inflation is too high. Once inflation is beaten down, interest rates will come down, and a lot of these stresses will go away.
Isn't this a canary in a coal mine, though? Haven't we had 4 of them now? Banks going under. Doesn't that tell you, Michael Contopoulos, that ultimately tighter credit conditions are around the corner, which will ultimately mean inflation is coming down?
Jonathan, I think it does. We have to separate inflation, I think, into 2 camps. You have, cyclical inflation, and then you have secular inflation. And on a cyclical basis, inflation is clearly coming down. We're far from the peak, June of last year. Now, if you look at trim means and things of that nature, probably not as far from the peak as we all wish we would be, but certainly inflation is coming down, and that will continue to slow as the economy slows, as labor slows, and ultimately services and rents and so on and so forth. And so clearly, to your point, this is a bit of a canary in the coal mine. We would expect lower inflation. By the way, that doesn't mean low inflation, it just means lower inflation. But the real issue is going to be, over the next 3, 5, 10 years, this idea of having structurally higher inflation. What does that mean for the banking system, on a longer term horizon? What does it mean for interest rates on a longer term horizon? What does it mean for growth over a long term horizon, both economic growth as well as growth stocks? And I think these are the questions that investors aren't necessarily thinking about enough, and not only investors, but it seems like banks weren't thinking enough about a structural shift in inflation and rate dynamics. And that's going to be a longer-term headwind, I think, that's underappreciated at the moment.
Well, I know you and the equity side of the team at RB are having that conversation, thinking about what that will mean for equity leadership as well, and these are important questions. Michael Kushner, it's an important question to consider as well with regards to how far the Federal Reserve will pull back. You believe this will be the last hike of this cycle, potentially. I think a lot of people are on board with you. But Michael Kushner, when they begin to cut, when that happens, not if, because ultimately they will at some point, what will they cut back to with everything Mike Kontopoulos just said?
It's a very, very good question. It really depends on how fast inflation is falling and what their ultimate target is. If they're willing to tolerate a slow grind lower in inflation over time, as long as it's going lower, they'll take their time cutting interest rates, barring any unexpected, negative surprises along the way with regard to financial stability or other shocks which may hit the U.S. and global economy. So longer term, I do think they want to get back to 2%. The question is, how fast do they want it to go back? And my gut feeling is that they're not willing to sacrifice, much higher, radically higher unemployment rates in order to get down inflation faster than what it could happen on a slower trajectory. So I think longer-term inflation will return to the 2.5% level, but it may not be to 2025.
That's precisely what I want to talk about in just a moment. Hold that thought. Michael Kushner alongside Mike Kontopoulos are going to be sticking with us. Just the latest on the information we got from the call from JP Morgan on First Republic moments ago. The last question on the call sounded like this. Over the course of 8 weeks, 3 of the top 30 US banks have failed. Looking forward, will the rest of the industry need to be capitalized and liquid the way JP Morgan is? Jamie Dimon, the CEO of JP Morgan, said this: people should take a deep breath and be very, very thoughtful about changes. We'll return to that in just a moment. JP Morgan higher by more than 4% in the pre-market. Let's get you some movers going into the opening bell. Here's Katie.
Well, John, let's start right there with First Republic. Obviously, the story of the day, second biggest bank failure in U.S. history. And like you said, JP Morgan coming to the rescue. You can see First Republic down almost 35% pre-market. Moving on, though, SoFi is catching a bid after a beat and raise quarter for adjusted net revenue. You can see shares higher, as are shares of General Motors after an upgrade from Morgan Stanley. Analysts there say the stock looks oversold and that GM is one of their top 5 auto stocks in Morgan Stanley's coverage. And finally, we have Carvana. Shares up slightly, 4% after its creditors proposed a debt for equity swap. I say slightly because Carvana had been up about 18% at one point this morning, but you can see that gains are cooling a little bit now.
Katie, thank you. More from Katie around the opening bell. Coming up, looking ahead to the Fed's decision after 4 bank failures in America in 2 months.
I do think that the Fed is likely to go ahead and hike later this week. The Fed is saying, okay, we can go ahead and hike one more time. We think this is a relatively contained implosion. We think that the economy is strong enough to go ahead and do that. That is a vote of confidence for the here and now.
That conversation up next.
The old saying that the Fed tightens until something breaks. I think that clearly they've moved at such a rapid pace that there's an impact on financial stability. It's hard to divorce the Fed's actions from what's happening in the banking sector. We're kind of hoping this is the last rate hike, but it tells you a lot about this Fed that they hiked in March when we had banking sector problems, and they look like they're going to go ahead in May. When we have banking sector problems, one would think that this is probably the end of the rate hike cycle at this stage of the game.
Something broke. Another bank down as the Fed gears up for decision day. The setup looking a lot like it did back in March. 6 weeks later, and the question remains the same. Are financial stability concerns enough to stop this Fed? For Wall Street, the consensus really hasn't changed. It's one more and done, with strategists doubling down on calls for another 25. For more, let's get to Mike McKee. Morning, Mike.
Good morning, John. Well, the question is, does First Republic represent any kind of systemic risk, or is it just an outlier, as SVB was? The Fed is probably betting on the latter. And right now, the markets are betting on that because, as you point out, the white line there shows the odds of a 25 basis point increase on Wednesday are about 92, 93%, while the odds of a rate cut in November are 78%. It's the first time a rate cut is priced in now. And the question is, will the Fed do anything to bring that blue line higher, to make it less likely for the market to bet on a rate cut? Now, they'll probably go back to some kind of language along the lines of what they used in 2006 when they stopped their tightening cycle, saying that they judge some inflation risks remain. The extent and timing of any additional firming that may be needed to address these risks will depend on the evolution of the outlook. In other words, something of a hawkish hold to let people know that if inflation doesn't come down, they're not done yet, but they think they've done enough for the moment. And then the question is, what do they know that we don't know about bank lending standards? The senior loan officer's report is expected to come out Monday, but a week from today, but they will already have much of the data. And as you can see, the senior loan officers have already reported that somewhat standards have tightened quite a bit. The white line is the significant tightening, which we're still behind on. But as you can see, we're still seeing banks make loans. It's flattened out the last couple of weeks. But as long as banks are still making loans, the Fed doesn't have to worry about the banking industry pulling back and hurting the economy. So we'll find out more when Jay Powell and the Fed talk to us on Wednesday.
Looking forward to it, Mike. Looking forward to it. And looking forward to that preview we might get of that senior loan officer opinion survey a little bit later on this month as well. How many banks have failed now? Silvergate, Signature, SVB, First Republic, throw in Credit Suisse. And every single time we've woken up on Monday morning, whatever day it was when SVB went under, and talked about it being idiosyncratic. A question we've asked on this program, how many banks need to go under before we stop calling it idiosyncratic? Back with us, Mike Kontopoulos, Michael Kushmer. Michael Kushmer, something you said moments ago I think is really, really important. We've all been asking the same question. What's the price we have to pay in GDP to bring CPI back down to 2%? And what you said, I think, is just as important, if not more important. Over what time period will the Fed force the economy to pay the bill? Now, Michael Kushmer, when you think about that, what do you think is the appropriate time period?
I think there's no reason not to take your time. Remember, the 1990s were a period of the beginning of the decade was inflation was pretty high, and it came down over the course of the decade. The Fed squeezed it lower, but the economy grew quite nicely in the 1990s. And I think the Fed wants to avoid this boom-bust cycle they've created in the past. And why can't we have a soft landing from the perspective of no dramatic rises on the unemployment rate, no big recessions, and just keep growth on the low side for an extended period of time to keep employment relatively high? This, I think, is in accordance with what their policy was prior to the COVID crisis in terms of trying to cause inflation to go up and be a little bit higher and have more inclusive growth down the road. So I think is directly related to that, but I also don't think that as long as inflation's coming down and long-term inflation expectations are anchored, there's no reason to force current inflation to drop precipitously simply to achieve that objective in the short run at the cost of much higher unemployment.
Is your approach
I think they should take their
bullish
time.
or bearish for credit?
I think it's bullish. I think big recessions are the bête noire, or the big problems for credit. And as long as the economy and nominal GDP growth are okay, companies are going to be able to pay back their debt. Their cost of borrowing may be a little higher than it was in the past. But again, when interest rates were these levels back in the 1990s, everything was just fine.
I sense, Michael Kontopoulos, that you might take the other side of that.
You know I will, Jonathan. Listen, I mean, I think everything Michael laid out is an ideal scenario, and it's clearly what the Fed wants to achieve. The question is, can they achieve it? And I think everything that we're seeing with SVB and Signature and Credit Suisse, First Republic, et cetera, shows that it's going to be impossible to have this mythical soft landing that everybody wants and that they are trying to achieve. But it's rarely happened in the past. It certainly hasn't happened when you have high inflation. I think the only cure for that high inflation on a cyclical basis is to actually cause unemployment to go up a couple hundred basis points to bring down service costs, et cetera. And that is not good for corporate credit. I mean, you're getting paid 135 basis points today on the Bloomberg, investment grade credit index, corporate credit index. I mean, that's no compensation for downgrade potential, increases in leverage, a decrease in interest coverage. Remember, as a bond investor, you want certainty. You want the certainty of cash flows. You want the certainty of rating stability. You want the certainty of strong leverage, interest coverage profiles. And if that uncertainty is going up, you need to be compensated for it through higher spreads and higher yields relative to risk-free. Not a good environment for credit in our view.
Mike Kontopoulos, Michael Kushner, to the two of you. Just wonderful coverage as always. Great to kick off the trading week with you. Thank you. We've been counting the bank failures, haven't we? 1, 2, 3, 4. Throw in Credit Suisse if you like. SVB, Silvergate, Signature, they went in March. April into May. First Republic goes as well. March, equities up. April, the S&P 500 higher. We're going to be talking about the stock market in just a moment. Coming up, the morning calls and later, JP Morgan's latest purchase. The largest US lender gets even bigger. We'll get the view from Cameron Dawson of New Edge Wealth. That conversation around the opening bell 7 minutes away, with the equity market on the S&P 500 negative 0.15%. Looking to get the month of May started in just a moment. Coming off the back of 2 months of equity market gains and 4 failed banks, equity futures totally unchanged through much of this morning on the S&P 500, negative by 0.16%. That's the price action. Let's get you some morning calls. First up, Morgan Stanley upgrading GM to overweight. $38 price target, seeing an attractive risk reward on both the relative and absolute basis. That stock is up by 2.8%. BofA upgrading Comcast to buy, saying the company's strong Q1 results likely represent an inflection point. And finally, Goldman downgrading Exxon to neutral. 125 price target, seeing better opportunities elsewhere after the stock's recent gains. That stock is down by almost 2%. Coming up, JP Morgan acquiring First Republic, the 4th US banking failure since early March. That conversation up next with Cameron Dawson of New Edge Wealth. Your opening bell is just around the corner. April kind of just disappeared. Welcome to May. Just like that, a new month. Equity futures, negative 0.13% on the S&P. On the Nasdaq, a little bit softer, lighter, lower too. No drama here. Plenty of drama in the banking sector over the last couple of months. We'll talk about that banking drama in just a moment. There's your opening bell. Switch at the board and get to the bond market. Going into a huge week for fixed income this week. Payrolls Friday, the ECB Thursday, Federal Reserve on Wednesday. Some ISM and data in between. Looking at the bond market now, yields higher by 5 or 6 basis points. The 10-year 347.87. In the FX market, bit of a snooze. The euro 110.26. And looking at crude, down by 1.9%, $75 and about 30 cents. About 20 seconds into the session, looking ahead to big earnings as well. Apple a little bit later this week on Thursday after the close. Unchanged at the opening bell on the S&P 500, slightly softer on the Nasdaq, negative 0.1%, but one stock to watch at the open. JP Morgan acquiring failed regional bank First Republic, taking over about $173 billion of loans, $30 billion in securities, $92 billion in deposits. Back with us, here's Shanali. Hey, Shanali.
John, we're watching before our eyes the big getting bigger. And now, remember, in order to do this, JP Morgan had to get approval from the regulators. They were hitting the nation's kind of deposit limit here when it comes to the big banks. So for them to be able to do that, you see the market likes it. The stock is up. They're absorbing some of the losses, but they're really loss sharing here with the FDIC. What's more is you have Jamie Dimon coming out and saying that we're getting near the end of this banking crisis. Now, does that mean that a couple more banks will get into trouble? If you take a look today, this morning, so far, the KBW Bank Index, it's up a little bit on the day. So that is showing you a little bit of confidence in the system here, and a lot of questions that would have been very controversial questions. This idea of a systemic risk exemption. What happens to the other of the depositors, the biggest banks that put their money into First Republic to save it? These questions are now off the table. JP Morgan is paying them back. Remember, Jamie Dimon in the first place brought his peers into the bank in order to give it more time. Now, JP Morgan is saying they didn't seek out the deal. But what we also know is that the FDIC really kind of reached out early in advance before putting First Republic into seizure here to make sure that there would be buyers at the end. And JP Morgan, among the biggest banks, was really the only of the bulge bracket that came up with a compelling bid. We understand that this bid, of course, and this is the way the FDIC works, is to lessen the hit to the deposit insurance fund. So there is some good news baked into here, but a lot of those questions that are under the surface remain unanswered. And the question is that enough to create confidence in the system as we watch more banks face pressure ahead on issues that have been lasting since this interest rate environment started to change?
Shonali, you're at the Milken conference this week together with Romain. I'm looking forward to the coverage from both of you. I know that that is the capital, the epicenter of the banking stress of the last couple of months. You're in California. Shonali, can you tell me the nature of the coverage over the next couple of days?
Yeah, absolutely. You have to think just about a half an hour from now, we're going to be talking to Apollo CEO Mark Rowan. Remember, Apollo has been a big private credit firm on the sidelines here that we've heard come up a couple of times here when it came to partnering with regional banks to get through this stress. In fact, among their peers, they are the biggest when it comes to the credit world. We'll also be speaking to Citigroup CEO Jane Fraser today for a lot of those questions about systemic risk and is the banking system safe? And by the way, John, is it safer when we have more banks that are bigger? What happens to the small and medium sized in the world? We'll be talking to some of the biggest credit fund managers in the world as well. We have exclusives with Katie Koch of TCW in her first interview as CEO of the firm, as well as Guggenheim's Ann Walsh. And they'll answer those questions about whether the credit markets, as we know, have been kind of eerily calm, haven't they? Whether there's more stress under the surface there.
Very cool. Brilliant conversations coming up with Shonali and the team. Shonali and Romain in some fantastic conversations through the week over the Milken conference. Shonali, thank you. Looking at JP Morgan, higher by about 2.5% right now. The South side overwhelmingly likes the deal. Gerard Cassidy weighing in on the deal and writing the following: we view this as very favourably as it gives JP Morgan approximately $175 billion in new loans, provides them with access to a large group of very attractive high net worth clients, and should help drive long-term returns higher for its shareholders. JP Morgan, the stock, is positive in early trading. We'll have a look at some of the other banking names out there at the moment. PNC and Citizens said to also have been asked by the FDIC to submit offers for First Republic. They were not successful. Kelly Lyons joins us now with more. Hey, Kaylee.
Yeah, John, those bids not successful. Therefore, they're missing out on everything Gerard Cassidy was just talking about in that note you mentioned, the idea that they could have gotten all of these assets at a very significant discount from the FDIC, but were not ultimately able to pull off the deal. The reason why, according to our reporting here at Bloomberg, is JP Morgan, even though it required a regulatory exception, given that it already had that 10% in deposits here in the U.S., was the cleanest deal offered to buy all of the bank, while the other bids, according to sources familiar with the matter, these other bids required that the bank be broken up and more complex financial dealing to deal with that $100 billion in mortgages. Hence why they were not ultimately selected. The FDIC taking a smaller hit to the deposit insurance fund as a result. And now taking a hit this morning are these two stocks, PNC, Citizens, each down nearly 5%. Losses for both of these banks now more than 20% year to date because, of course, they have not been immune to the pain we have been seeing in certain parts of the banking sector, John.
And Kaylee, we've heard from Treasury already on this. Their statement read as follows: we're encouraged that this institution was resolved with the least cost to the deposit insurance fund and in a manner that protected all depositors. You're in D.C., Kaylee. How's this playing out in the nation's capital right now?
Well, it depends on if you're asking Republicans or Democrats, John, because Democrats like Sherrod Brown, the senator who chairs the banking committee, is out saying that this shows the need for stronger regulation, just as he said in the aftermath of Michael Barr's report that was released on Friday. Then you look at Chair Patrick McHenry, who heads House Financial Services. He was talking about how this should not be politicized. The Biden administration should not politicize this kind of moment with regulators, and saying that really this is the question now of the FDIC, considering it acted so quickly to get this bank sold when it failed. And in the case of SVB, it took weeks to actually see a sale of those assets follow through. So there definitely are some questions as well as to the timeline of this process, and just an ongoing area in which it's hard to find bipartisanship, John.
Hey, Kayleigh, thank you. Looking forward to catching up with Anne-Marie about 10 minutes from now. AMH down in Washington on the reaction from lawmakers across Washington. I want to get back to the earnings just briefly. Norwegian Cruise tripling revenue, delivering stronger than expected Q1 results. The cruise line seeing, quote, strong booked position and higher pricing for the remainder of 2023. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Norwegian currently up about 1.7% as trading kicks off, and some remarkable size and scopes that you walked through, but still a smaller than expected loss. We're still talking about a loss. If you look at first quarter adjusted loss per share, it came in at 30 cents. Analysts had been penciling in a loss of about 43 cents a share. And then if you take a look at revenue, you take a look at occupancy, both of those metrics came in a bit better than expected. And the full year forecast was better than expected as well. So definitely better than feared for Norwegian, if you want to call it that. But it's still playing catch up to a lot of its peers. Year to date, you're looking at Norwegian lagging Carnival and Royal Caribbean, the latter up 33% this year. For context, Norwegian is in orange there. It's sitting on gains of about 9.5% so far in 2023.
Katie, thank you. About 7 or 8 minutes into the session, JP Morgan still positive. Up by about 3% right now, up by 2.9% on JP Morgan. More earnings still to come this week. Cameron Dawson of New Edge Wealth joins us right now. Cameron, I want to come to you on this question. 4 banks have failed in 2 months, and we've had 2 months of equity market gains. People looking at that from a distance will be asking why. What's the best way of answering?
I think it's because the resolutions have been somewhat orderly, and we have not yet seen any contagion from bank failures into the broader economy. But I think the operative word there is yet. And I think that the reason that there hasn't been contagion is also why the Fed is still raising rates and likely to do so again this week, despite those bank failures. So we're still in a mode of wait and see of how much these banking issues could actually trickle out into the broader economy. And it really depends on loan growth. And it is interesting that you did hear from Jamie Dimon this morning mention bank loan growth possibly slowing in response to this. But we're also hearing this from the other regional banks, talking not necessarily about balance sheet shrinkage, but repositioning or refocusing. That could all point to slowing loan growth, which will eventually impact the broader economy, which would eventually impact earnings. But it simply takes time, which is why equity markets have shrugged it off for now.
Is this resilience insulated by great tech earnings, or complacency then?
I think it's a bit of both. The fact that tech had rallied so much going into this earnings season and continued the rally showed you that it really was a show me story for tech names. Now they are trading at high valuations, but the earnings have improved rather materially. But that is masking weakness under the surface in a lot of other names within the index. You've seen breadth, so the measure of the names participating in this rally, really start to fade. And what's interesting is that there also have been really muted reactions in other parts of the market to strong earnings. A great example of this is Caterpillar last week. They beat, they raised, they're a cyclical company, and yet the stock sells off on that because it's sort of, this is as good as it gets. And so if we continue to see muted reactions under the surface, I think that could point to maybe a bit more shaky ground and maybe some selling off post this big rally.
The team at Bloomberg Intelligence noticed the same thing. They were crunching the data. Just to quote the team here at Bloomberg, nearly 81% of S&P 500 companies have beaten analyst estimates, the biggest proportion since the third quarter of 21. The median stock has outperformed the index by just 0.1% on the day of results. They're not being rewarded for this, Cameron. Now, with that in mind, what does that mean for Apple going into Thursday?
Yeah, I think that it means that there is a very high bar because, again, you have seen a rally into those earnings. And what's interesting with Apple is that if you look at this quarterly profit, it's been flat for the past 2 years, but the stock is up 30%. So there's a lot of optimism baked in. So it means that Apple likely has to kind of blow the lights out in order to see an upside surprise and really get the stock to further rally, mostly given the fact that it's trading at about 26 times earnings. So I think that the bar gets increasingly high post these rallies, given the fact that you've already seen the valuations return back to pandemic level, multiple kind of bubble level valuations.
Given this backdrop then, Cameron, what are you advocating for? Where do you think people should be in this market?
It's a little bit trite at this point to continue to talk about quality, but given the fact that we are still in the midst of a great deal of economic uncertainty, quality is of utmost importance. But as we talked about with Apple and some of the tech names, really having valuation discipline is very important in this time, mostly if you see interest rates start to crawl higher again. We're now at valuations for a lot of growth stocks that are above the pre-pandemic levels when interest rates were much lower, liquidity was much more abundant, which just means that though we had hoped that valuation risk was the 2022 story, it's now becoming a 2023 story because of the rally that we've had. So it's about focusing on balance sheets, focusing on free cash flow, but not forgetting that you can't pay any price for those kind of characteristics.
And Cameron, I just wanted to squeeze this in. You put out a note in the last couple of days on the debt ceiling issues. Is it just your base case that this will lead to reduced growth?
Well, if we have a similar response that we had in 2011 with sequestration and budget cuts across the board, then yes, we should see a fiscal drag that should reduce growth and should reduce earnings growth as well going forward. And then it's a question as well about liquidity. This is probably the most underappreciated dynamic in this market, which is that in the lead up to the debt ceiling, we've seen a huge liquidity injection because of the spending down of the Treasury general account. Once the debt ceiling is resolved, the Treasury goes back to issuing bonds. That liquidity tailwind becomes a headwind, and that's where we could actually see the resolution of the debt ceiling be a net negative for this equity market.
Interesting. Cameron Dawson there of New Edge. Cameron, always wonderful to catch up with you. Thanks for being with us. Looking at the broader market right now, 13 minutes into the session, we're negative 0.1%, or rather positive 0.1% on the S&P. The Nasdaq just about positive on the Nasdaq this morning. On the composite, the Nasdaq 100 is negative 0.07%. Coming up, the FDIC brokering a deal between JP Morgan and First Republic.
It is likely that we have seen the last of the First Republic brand. So whenever someone like JP Morgan acquires another entity, clearly that's going to be folded into JP Morgan.
We'll get the response from Washington next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Apollo CEO Mark Rowan. That conversation at 10 a.m. Eastern, 3 p.m. in London. This is Bloomberg.
I think this puts to rest, the whole discussion on who's next. The provided solution is the best cost solution for the FDIC and the government, right? And then you pair that with pretty good mid-cap bank earnings as it relates to deposit flow versus the fears in the market. I think this should lay to rest the acute liquidity worries that the market has for the banking system.
Really thoughtful stuff, as always, from Erica Najarian there of UBS on JP Morgan. The Treasury praising JP Morgan's takeover of First Republic, writing this: "We're encouraged that this institution was resolved with the least cost to the Deposit Insurance Fund and in a manner that protected all depositors." Senator Warren had a different take, criticising the outcome and tweeting the following: "A poorly supervised bank was snapped up by an even bigger bank. Ultimately, taxpayers will be on the hook." For more, let's get to Anne-Marie down in Washington. Morning, Anne-Marie. The latest response, not great from the likes of Senator Warren, but largely expected.
Largely expected. We're also hearing the same from Sherrod Brown, the chair of the Banking Committee in the Senate. He's saying that more guardrails should be in place. So again, this debate, Jonathan, of regulation, should there be more, should there be less, that is taking center stage once again this week in Washington. It also comes to the Senate this week is going to have a hearing on how executives potentially were part of the failure at SVB. And I'm sure First Republic Bank is going to get a mention in that hearing as well. On the other side, we do have Representative Patrick McHenry. He's the chair on the House side of banking. And what he says is that he was happy with what happened in terms of First Republic Bank. But he does say he does not want to see the Biden administration politicizing the situation. So all those debates we've been having since early March, when we first had the failure of SVB, they're coming back in vogue.
Mate, you're going to have a busy week. Not just the outcomes, the consequences of all of this stuff and whether we have to do it again with another financial institution, the debt ceiling. So the House Republicans are waiting for Senate Democrats to come up with their own deal for all of this and come up with their own debt limit thing to pass the Senate and then to argue about with the House, and a president seemingly not trying to engage in any of it at the same time. Anne-Marie, what's the prospect of the Senate and Democrats getting together and passing anything anytime soon?
Well, before that happens, Jonathan, you also have Senate Majority Leader Chuck Schumer putting out a Dear Colleague letter talking about the fact that he's going to have hearings on the House Republicans' plan. Hearings that he says this is a kind of bill that didn't go through the proper committees and wants to remake American society. So before they even start drafting their own plan, they're looking at bashing what the Republicans in the House have put forward. At the same time, you have business groups really trying to pressure the White House and Biden to get in a room and have a proper negotiation with McCarthy's team. And this is something that potentially can hurt the White House because they thought that it was better to really put the blame on the Republicans in Congress. This is Congress's bill to try to get through. They're demanding a clean debt ceiling, but now business groups are saying, you know what, you need to step in. The question is, will Biden acquiesce or not? And if potentially he was able to get a deal done, more so to your question, maybe it is in the Senate when he has McConnell and Schumer come to the table. The issue is it's right now, at the moment, Mitch McConnell has really been hands off and has deferred all of this to Speaker McCarthy.
Have you seen any sign whatsoever that this president is willing to engage? Any movement whatsoever following that win, in the eyes of a lot of people, for Speaker McCarthy last week?
Right now, what the White House maintains is what they have been since the president and Speaker McCarthy sat down in early February, and that is that they will only go along with separate tracks of negotiations. There has to be, what they say, a clean debt ceiling bill, and then they will negotiate about the budget and spending. But at the moment, Jonathan, this is where the pressure is coming from. It's not just Republicans. There are some Democrats who think the president needs to get in the room. Most notably, we heard from Senator Manchin, but also now business groups like the U.S. Chamber of Commerce. They want the White House to start these negotiations because also many are saying the X date could be moved up, and we're still waiting for that exact date from the Treasury.
Yep. AMH, thank you. Great coverage this morning, as always, down in Washington on the latest after JP Morgan acquired First Republic, and on the latest on the debt ceiling debate, which will go on and on and on until, I guess, it doesn't and we hit the X date and we've got to do something about it. Let's get you an update on the economy, the momentum we've got in the US economy going into all of these issues. Mike McKee has the data. Hey, Mike.
Good morning, John. Well, we don't need to talk about the debt ceiling this week because we got a lot of other stuff that's going to occupy traders. First up this morning, the S&P Global U.S. Manufacturing PMI. It's little changed, 50.2. It was 50.4 last month, so I'm not sure what you make of that. But coming up is going to be the ISM Manufacturing Index, and that obviously gets a lot more publicity. It's going to be the number of the day here, and we are expecting a slight rise, still under 50, but 46.8 compared to 46.3. We shall see. Then the rest of the week really gets going. Jolts tomorrow, European manufacturing PMIs, then on Wednesday, the ISM services, and of course, there's a small Fed decision coming out on Wednesday. Thursday, jobless claims, and we've got an ECB decision. So if you're worried about what higher rates are doing to the economy, you'll get a chance to see what happens by the end of the week. But you can't think about it too much because Friday is Jobs Day.
Mike McKee, what a week we've got coming up. Let's just get through the Fed first. Let's do Wednesday and then think about Thursday and Friday before we do that. Mike, looking forward to your coverage through the week, as always, buddy. The ISM, jolts, then the ISM, then jobless claims, the ECB, then onto payrolls and a Federal Reserve decision somewhere in between on Wednesday. Let's get you the sector price action this morning. Here's Katie.
John, not too much movement either way. You can see the S&P 500 up 0.2%, 8 sectors in the green right now, led by industrials. At the bottom of the pack, it's energy, off about 0.2%, just 3 sectors in the red right now on what looks to be a quiet day so far.
Katie, thank you. The broader equity market just about holding up by 0.2% on the S&P 500. Quiet day so far. I'd have to agree. Outside of that deal with JP Morgan and First Republic, all is quiet. Going into a very, very busy week. Your trading diary is up next. What a week we've got coming up for you. About 26 minutes into the session, we're positive 0.1% on the S&P 500. Following that deal between JP Morgan and First Republic, let's get straight to the trading diary. Your week ahead looks like this. ISM manufacturing numbers at the top of the hour. Factory orders and durable goods out tomorrow. Wednesday, the main event. It is the Federal Reserve decision followed by Chairman Powell's news conference. ECB decision coming on Thursday. Apple earnings same day after the closing bell. And then rounding out the week with payrolls coming up on Friday. You couldn't design a busier week, could you? From New York City, that does it for me. Looking forward to covering these issues with you. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.